Good day, guys. Welcome to my channel once again. And this time around, it is not really more of a teaching this thing. It's more of like an advice on how you account for transaction in financial accounting. Based on my experience, I noticed that the reason why most students do fail their account or they do not understand account is the lack of understanding of this basic topic called principle of double entry in accounts. So this is what we are going to do for today. I won't be treating any question today. I'll just show you the steps on how you can understand principle of double entry, and you don't have to cram it or memorize anything. So here we go. Now, this is the principle of double entry, and it states that for every debit entry, there must be a corresponding credit entry. So this is what they mean. For every debit entry, there must be a corresponding credit entry. And it also says you debit the receiver and you credit the what? Giver. Now, most students they assume that okay, debit the receiver and credit the giver. Now, for example, now when they say debit the receiver, credit the giver, let me give you a transaction. Started business with cash of yeah. Started the business with cash of what? 100,000 naira. So before this, you need to know the accounting concept and convention so that it can also help you in what? Solving the question on principle of double entry. No, now back to the question. The step one is to what? Recognize the accounts that are involved. So what are the two accounts that are involved? So let me call it recognition. So what are the two accounts involved in this transaction? The business and what? Cash. Right? So those are the two parties involved in this transaction. Let's name them. One and so now what do we represent the business name with? We represent it as equity, or you can also call it capital. So capital account and what? Cash account. That is step one. Step two, identify who is receiving and who is giving. Identify the receiver and giver. So who is giving? Now, in this scenario, you started a business. According to business ethics concept, it states that the owner should be treated as a separate entity from the business. So the business is an artificial person. So the business is different from the owners, right? Now, when you are putting money into the business, you are putting money into the business like as an individual. Two things are involved. Who is receiving, who is giving? Now, you might say that, well, the business is receiving money. Yeah, you are correct. If the business is receiving money, the business is receiving money of what? Cash, right? The business receive money of cash. How much? Okay, let me just do it as the receiver. Is the receiver. Then who is the giver? Capital. Since capital is used to start a what? A business. So capital is the what? Giver in this transaction that I've just explained with you. Receiver, giver. Then you now apply the principle of double entry that says debit the receiver, credit the giver. That's step three. Always apply this whenever you come across any transaction, then you will not have any problem. I'll be giving you a few more examples, then you can call it a day. So you debit the receiver and credit the giver. So you must the debit comes first. You debit cash of how much? 100,000. Then you credit what? Capital 100,000. Then you can now record it in your ledger. Your cash account. We still go into this in the nearest future. Your debit and your credit side. Your naira sign. So you are debiting the receiver. Now how do you record this? This is your what? Your cash, right? Then who gave the cash money? Capital. So that's why you see capital on your debit side in your cash book. And that is how much. You record it with the amount. 100,000. Then here you put what? Cash. 100,000. Hope you understand. Now let me give you another question. If this seems to be confusing to you. Bought goods by cash. 20,000 naira. Bought goods by cash. 20,000 naira. Now if you feel that you can attempt this, you can press pause and give it a try. But if you cannot, then here we go. The two accounts involved, they are what? Bought goods and what? Cash. In accounts, whenever you buy goods, remember purchases is what? Goods bought for resale. So it is recorded as an purchases account. So the two accounts involved, they are purchases and what? Cash. So now who is giving, who is receiving? Purchases is what? Receiving. And what? Why cash is what? Giving. Why? Because if I go to the market or to a store, then I want to purchase something as a business, I give them the cash while they give me the goods. So that is the reason why purchases is receiving and cash is what? Giving. Now the way you record bought goods is different from the way you record what? Bought what? Motor van for cash. 75,000 naira. So I'll be going into this, but before I move on, so you debit what? Purchases with the amount 20,000. Then you credit what? Cash account with 20,000. Why? Because purchases account and cash accounts are the one involved in this transaction. Then I debit the receiver and credit the giver with the same amount. Hope you guys understand. So I think I'll be stopping it with this motor van. Now there are two accounts involved. Bought motor van for cash. Motor van is the one involved and cash account is involved. Now why are we not using purchases? Purchases is an what? Goods. It is an what? It is an inventory. Why motor van is a what? It is an asset, a non-current asset. This one are what? Consumed or resale in the accounting period. It doesn't last more than an accounting period or more. While this account, it's going to last for at least a minimum of 5 years. Therefore, the way you prepare this transaction is different from the way you record this transaction is different from the way you record this transaction. This one is bought for resale, while this one is meant for use. Therefore, they cannot be prepared in the same way. So now, without wasting much of the time, the two accounts involved here are what? Motor van, which is a non-current asset, and what? Cash. Motor van is what? When you go to where they sell the motor van, they are the one that is going to receive what? The amount of money. While you pay cash. Therefore, money is flowing out of the business, and motor van is what? Receiving. Therefore, this is a what? An outflow. While this is a what? An inflow. Then you put. So you do what? This is the what? Receiver. and this is the what? Giver. Now you debit the what? Receiver and credit the giver. So motor van, you debit it and you credit your what? Cash account with the same amount, 75,000. Then you can prepare your ledger if it is required of you to do so. So this is where I'll be stopping. But before I move, I need to give you a summary of how you record, or another clue that is going to help you in recording of all your accounts. So let me start with this place. I call it elements of what? Financial statement. So there are just 5. So we start with your assets, then you have your liability, you have your income, you have your expenses, then you have your what? Equity, or also known as what? Capital. So now let me divide this board for you guys. So now this is when you debit and this is when you credit. And I want you guys to take note of this. When there's an normally, this will always have a debit balance and this will always have a debit balance, while the rest will always have a credit balance and a credit balance. Take note of it. Asset and expenses will always have a debit balance. So the two is going to come first. Whenever you have an increase in what? Assets. Number 2. Increase in what? Expenses. You always have what? A debit balance. Whenever there's an increase, for example now, there was a cash is a current asset. So when there was an increase, then what happened to it? We debited it here. But when there was a decrease, what did we do? We credit it. So therefore, this comes here. A decrease in assets, you credit it. If I'm to open a ledger account for this, then you see that I'm going to credit it. I'm going to do that, then you can call it again. Whenever you have a decrease in what? Expenses, you credit it. Now what else do we debit? Decrease in what? Decrease in what? Liability. Number 4. Why on the other side you have what? Whenever there's an increase in liability, you credit it. Why? Because its normal balance is what? A credit balance. We also have a decrease in income. Yeah, increase in income. Number 5. Then whenever we have a decrease in capital, you debit it. Whenever we have a what? Increase in capital, you credit it. So with this, if you have been listening so far, what I've been explaining, then you should be able to understand that if you can understand this principle here and this principle here, then you won't have any problem as regarding the principle of double entry. Another thing I also want you guys to take note of is that without you understanding the basic principle of double entry, you cannot understand financial accounting. You always have a problem with it. So try as much as possible to understand and digest this very well so that it will help you in the future. Now, There are these 5 elements of financial statement. I won't be explaining it in this video. I'll be shifting it in our next video. Thank you. Okay, before I move, I promise you guys that I will draw the ledger for this transaction where we have purchases and cash account. Remember, this is the what? Receiver, and this is the what? Giver. So what happens to the receiver? You debit the receiver. So now I'm going to debit purchase with what? Cash. How much? 20,000 naira. Then now you credit the what? You credit the giver with how much? The same amount. Then the particular you put what? Purchases. So now as for this, I want you guys to do it for me and no, sorry. For this third transaction, you guys should solve it and post your answer in the comment section below. Thank you very much for watching our video up to this point. See you in our next class. Thank you.